91 seconds ago, at exactly 8:30 a.m. Eastern Time, the U.S. Bureau of Labor Statistics released the initial jobless claims data for the week ending April 12, 2026, and this is not a normal weekly employment report. This is the first genuine post-tariff labor market signal that captures the actual economic impact of the Section 301 tariff announcements made on April 2nd and the energy price shock from the Iran conflict that sent gasoline up 21.2% and diesel up 42% year over year as of last week's PPI data. Every prior jobless claims release for the past 6 weeks has been pre-tariff data. Backward-looking numbers from before the dual shocks of trade policy, uncertainty, and war-driven energy inflation hit the real economy. Today's number is the first forward-looking signal of whether the U.S. labor market is absorbing the shock or beginning to crack under it. The headline number? 227,000 initial jobless claims for the week ending April 12th. That is above the Bloomberg consensus forecast of 220,000. It is 7,000 higher than expected and 24,000 higher than the prior week's 203,000. And it is the highest single-week print since February 22nd, 2026, 8 weeks ago, when claims briefly spiked to 231,000 during a winter weather disruption before falling back to the low 200,000s through March. But here is why the 227,000 headline number is not the most important data point in today's release. The number that matters more for silver, gold, the dollar, and Fed policy expectations over the next 30 days is buried 3 lines down in the BLS report. The 4-week moving average of initial claims, which rose to 217,250, up 7,750 from last week's 29,500. That is a poor 3.6% weekly increase in the smoothed average, and it puts the 4-week MA just 7,150 points below the 225,000 threshold that labor economists and Fed watchers use as the alarm level signaling that labor market deterioration is accelerating rather than stabilizing. Let me show you exactly why that 7,750 point cushion matters so much by walking through the specific mechanism by which jobless claims feed into Fed policy decisions, which feed into dollar strength, which feeds into silver prices. Because this is not theory. This is the documented playbook the Federal Reserve has followed for the past 18 months, and today's data just moved us 1 week closer to the point where that playbook forces a policy response that silver investors need to be positioned for before it happens. Start with the Federal Reserve's own labor market analysis framework as outlined in the March 2026 FOMC minutes published on April 9th. The minutes explicitly state, participants noted that the labor market remains relatively tight, but acknowledge that several indicators suggest gradual softening. A sustained rise in initial claims above $225,000 on a 4-week average basis would warrant close monitoring, as it could signal a sharper than expected cooling. That language, sustained rise above 225,000, is not casual phrasing. It is the specific threshold the Fed has pre-communicated as the trigger for reevaluating the balance between their inflation-fighting mandate and their maximum employment mandate. Right now, the 4-week moving average sits at 217,250, 7,750 points below the 225,000 trigger. But here's the math that makes next week's claims data critical. If next Thursday's report, covering the week ending April 19th, comes in at 230,000 or higher, which is only 3,000 above today's 227,000 print, the 4-week moving average will cross above 225,000 for the first time since late 2023. And when it does, the Fed's own forward guidance says they will warrant close monitoring of labor conditions, which is central bank code for we are now concerned about recession risk and may need to pivot from inflation fighting to growth supporting. That pivot, from hawkish inflation focus to dovish growth concern, is enormously bullish for silver because it signals the Fed will cut rates sooner and faster than currently priced. The market is currently pricing approximately 70-80% probability of a June rate cut after Tuesday's core PPI came in at 0.1% versus 0.5% forecast. But that pricing assumes the labor market holds steady. If the 4-week claims average crosses 225,000 next week, June cut probability jumps to near certainty, 95% plus, and the market begins pricing a second cut in September and possibly a third in December. Each additional rate cut priced into the curve weakens the dollar by approximately 40 to 60 basis points on DXY based on the correlation observed over the past 12 months. And each 50 basis point DXY decline corresponds to approximately $2.80 to $3.50 higher silver prices based on the 0.87 inverse correlation between DXY and XAG USD. So the chain reaction triggered by jobless claims crossing 225,000 is this. Claims, 225K. Fed pivot from hawk to dove, Rate cut expectations accelerate. Dollar weakens 40, 60 bpitas per cut priced. Silver gains 280, 350 per 50 BP as a DXY decline. 3 cuts priced. Sugar 840, 1050 silver upside from current $79 level. Target 87.40, 89.50 by year end. But here's the counter-argument that makes today's data genuinely uncertain rather than bullishly obvious. The same BLS report that showed 227,000 initial claims also showed continuing claims, which measure people still receiving unemployment benefits after their initial claim, declined by 4,000 to 1.812 million for the week ending April 5th. When initial claims are rising, more people filing new claims, but continuing claims are falling, fewer people staying on benefits long term. It creates an ambiguous signal. It could mean the labor market is experiencing temporary disruption, initial spike, but workers are finding new jobs quickly, continuing decline. Or it could mean we are in the early stages of a deteriorating cycle, where the initial spike is just beginning and the continuing claims have not yet caught up. The historical pattern from the 2001 recession and the 2008 financial crisis is that initial claims lead continuing claims by 4 to 8 weeks. Initial claims spike first as layoffs begin, and then continuing claims rise 4 or 8 weeks later as those laid-off workers remain unemployed. If today's 227,000 initial claims spike is the start of a cycle, we will not see it confirmed in continuing claims until the May 9th or May 16th reports. That gives the market 3 to 4 weeks of ambiguous data, where bulls and bears can both construct plausible narratives, which typically results in range-bound price action rather than directional breakouts. For silver specifically, that translates to, if today's 227,000 print is confirmed by next week's data, staying elevated or rising further, silver likely breaks above $81 or $82 resistance and targets $85.87 by end of April on accelerating Fed cut expectations. If next week's data reverses back toward 210,000, 215,000, suggesting today was a one-week anomaly, silver likely pulls back toward $76, $78 as the June cut narrative weakens and the dollar stabilizes or strengthens. Now layer the tariff mechanism on top of the employment data, because this is where today's report gets genuinely alarming for the medium-term outlook, even if the immediate silver price reaction is muted. The Section 301 tariff investigations announced on April 2nd target Mexico, which produces 25% of global silver supply, China, and 75 other countries with potential tariffs of 15 to 25% to be implemented as early as July 24th, 2026. Fresnillo, the world's largest primary silver miner, already cut 2026 production guidance by 9-11% under uncertainty alone before a single tariff dollar was collected. When tariffs are announced but not yet implemented, companies face a decision tree. Option A is to wait and see if tariffs actually happen, risking being caught unprepared. Option B is to preemptively adjust, cutting production, reducing headcount, delaying capital expenditure, to position for the worst-case scenario. The 227,000 jobless claims print suggests companies are choosing option B. They are laying off workers now in anticipation of tariffs that may or may not land in July. And once those layoffs happen, they do not reverse quickly, even if tariffs are delayed or softened, because rehiring involves recruiting costs, training costs, and operational disruption. The specific industries most exposed to Section 301 tariffs and Iran energy shock are manufacturing, logistics, transportation, and retail, which together employ approximately 38 million U.S. workers. If even 1% of that workforce, 380,000 workers, face layoffs or reduced hours over the next 8 weeks due to tariff uncertainty and energy cost inflation, the 4-week moving average of jobless claims will easily exceed 225,000 and could approach 240,000, 250,000 by June. At that level, the Fed faces a genuine stagflation dilemma. Inflation still at 3.3% CPI, while unemployment is visibly rising. Historically, the Fed has always prioritized employment over inflation when forced to choose, which means rate cuts happen even if inflation is elevated. Bullish for silver. But in the short term, next 2 or 4 weeks, the uncertainty about which mandate the Fed prioritizes creates volatility rather than direction. Here's the trading implication for silver holders as of 8:19 a.m. Friday, 11 minutes after the data released. The immediate market reaction has been DXY dollar fell 11 basis points from 98.71 to 98 to 860 in the first 5 minutes after the print. Dovish red, labor softening. Tomorrow's Fed cuts closer. 10-year Treasury yield dropped 3 basis points from 4.28% to 4.25%. Same dovish red. Gold spiked $8 from $4,778 to $4,786. Monetary easing bet. Silver initially jumped 0.34 from $79.04 to $79.38, but has since pulled back to $79.21 as of the second, 8:20 a.m., suggesting the initial dovish reaction is being faded by traders who see the 227,000 print as noisy rather than confirmatory. The key level to watch over the next 3 trading hours, until 11:30 a.m. Eastern when volume typically peaks, is whether silver holds above 79 or breaks below 78.80. If it holds 79.0 plus, it confirms the market is reading today's data as dovish, labor softening, cuts coming, dollar weak, silver strong. If it breaks $78.80, it confirms the market is reading today's data as ambiguous. 1 week spike, need confirmation, no policy change yet, dollar stabilizes, silver range bound. Now connect today's jobless claims to the other 4 major data points that hit markets this week to see the complete macro picture for silver. Monday, April 14th, silver crashes from 70.19 to 72.61 on Islamabad talks collapse, plus blockade announcement, war shock, energy spike, inflation fear, Fed trapped. Tuesday, April 15th, core PPI, PLISR 0.1% versus PLISR 0.5% forecast. Hard inflation cooling, Fed can cut, dovish pivot. Wednesday, April 16th, Trump, war very close to over. Plus, S&P hits all-time highs, CR, peace optimism, risk on, Fed cut narrative strengthens. Thursday, April 16th, silver hits 80.33, rejects hard, closes 79.56, technical resistance, profit taking, weekend binary risk. Friday, April the 17th, today, jobless claims 227K. 4-week MA, 217, 25K, truckers, labor softening, stagflation risk emerging, Fed dilemma confirmed. The through line across all 5 days is uncertainty. War or peace, inflation cooling or persistent, labor strong or weakening, Fed cutting or holding. Every data point this week has been ambiguous enough to support both bullish and bearish narratives, which is why silver is range-bound $79.81 instead of breaking out above $82 or collapsing below $76. Here's my framework for the next 72 hours based on today's jobless claims data. If next Thursday's claims, April 24th release covering week ending April 19th, comes in below 215,000, labor market false alarm. Today's 227K was noise. 4-week MA stays well below 225K. Fed stays hawkish. June cut probability drops to 50-60%. Dollar strengthens. Silver tests 76,070 dollar support. 215,000 to 225,000. Labor market gradually softening but not alarming. 4-week MA approaches but does not cross 225K. Fed stays data dependent. June cut stays 70-80% probable. Dollar range bound. Silver chops $78.81. Above 225,000. Labor market accelerating deterioration. 4-week MA crosses 225K trigger. Fed forced to acknowledge recession risk. June cut near certain, 95%. September cut gets priced. Dollar weakens 50 plus BPS. Silver breaks $82, targets 85.87. It is now 8:31 a.m. Eastern. Silver is at $79.18. The DXY is at 98.58. The 10-year yield is at 4.24%, and we are exactly 1 week away from the next jobless claims print that will either confirm today's spike or dismiss it as noise. The first post-tariff labor data just told us the U.S. economy is under stress. The question is whether that stress is temporary and manageable or structural and accelerating. Silver's price over the next month depends entirely on which answer the data confirms. This is the hidden AG, man. Friday, April 17th, 2026, 8:31 a.m. Eastern. The labor market just blinked. Watch next Thursday.